Hi, I'm Wes Burke, CEO of Central Coast Lending. I wanted to take a minute today to share with you some of the details from a new program that we've launched called Project Lighthouse. This is where we leverage relationships that we have with highly productive real estate firms, and we pair a loan officer to conduct office hours within that brokerage. So this is not like a full-time commitment within the brokerage, but it looks like something like 2 hours a day, 2 or 3 days a week. So it creates a really mutually beneficial situation between the real estate brokerage and the loan officer. The loan officer has the opportunity to share expertise and help agents with deal structure, unique programs, and all the benefits of in-house underwriting that Central Coast Lending brings to the table. Gives the loan officer a chance to develop relationships with these realtors and increase their referral partnerships. If this is a program that sounds interesting to you, I'd like to share more details with you, and you can reach out to me direct on my cell phone number. That's area code 805-801-7061. Hope you're having a great day. Thanks for taking the time to check this out. And stick around here for the weekly mortgage market update made just for loan officers. Cheers. The purpose of these updates is to consolidate what is moving mortgage rates, explain where the market may be headed, and translate that information into practical strategies loan officers can use to generate business. And today's market can be summarized in 4 words: less bombing, more rallying.
This morning, the 10-year Treasury yield is trading near 4.65%, down roughly 3 basis points, while UMBS 5.5 mortgage-backed securities are up about 16 ticks, trading near 99.28. Mortgage News Daily's most recent 30-year fixed index finished Friday near 6.81%, while Freddie Mac's weekly survey came in at 6.58%. Consumer mortgage rates remain near their highest levels in almost a year. Here's the secondary market read. MBS are participating in this morning's Treasury rally. Today, at least initially, the mortgage basis is behaving reasonably well.
The catalyst is the pause in military strikes between the United States and Iran. There is not a formal, durable ceasefire yet, but the pause has reduced the immediate threat to oil production and shipping through the Strait of Hormuz. WTI crude dropped more than 6% to approximately $84 per barrel, while Brent fell nearly 7% to around $90. The 10-year Treasury yield declined as the oil move reduced some of the inflation premium that had been building into bonds. Higher oil raises inflation expectations, which pressures bond prices, which raises yields, which lifts mortgage rates. Today, that chain is moving in reverse, but this is still a headline-driven market.
Here's the Chrisman-style inside baseball point. Using the Mortgage News daily rate of 6.81%, and this morning's 10-year yield near 4.65%, the public mortgage to Treasury spread is approximately 216 basis points. That is a useful loan officer proxy, and it remains wide. Translation: even though Treasury yields are improving today, lenders have room to retain some of that improvement instead of passing all of it through to borrowers. MBS are up, but the primary-secondary spread remains a cushion between the bond market and the consumer's rate sheet. For locking decisions, today may offer some relief, but this is not a market where I would aggressively gamble on a multi-day rally, especially with the Fed meeting directly ahead.
This morning's durable goods report was mixed. Headline orders rose just 0.3% in June. But core capital goods orders, a proxy for business investment, rose 0.9%, and core shipments surged 1.9%. So the headline was bond-friendly, but the underlying details do not point to an economy falling off a cliff. Business investment, particularly spending tied to artificial intelligence and technology infrastructure, remains firm. Rates usually need sustained evidence of weaker growth or lower inflation, not one soft headline to make a durable move lower.
The Federal Reserve begins its 2-day meeting tomorrow and announces its decision Wednesday afternoon. The majority expectation is still that the Fed holds rates steady, but futures markets are assigning a meaningful probability to a hike. Reuters reported approximately 38% odds of a Wednesday increase, with much higher odds of a move by September. The market then gets second quarter GDP on Thursday and the Fed's preferred PCE inflation data on Friday. So today's rally is helpful, but the highest risk events of the week are still ahead. Here is your practical playbook. First, contact every active pre-approval and borrower who was discouraged by last week's rate spike. You have a legitimate reason to reopen the conversation. Bonds and MBS are improving today. Second, stay close to your floating borrowers. A better reprice could create a lock opportunity, but headline risk and the Fed make complacency dangerous. Third, talk to your realtors about buyer demand. Despite elevated rates, total mortgage applications increased 1.9% last week, and purchase applications rose 6%. Refinances declined 2%, so the immediate opportunity remains purchase-driven. Fourth, lead with payment strategy, not rate prediction. Use seller credits, temporary buy-downs, FHA, VA, and carefully selected ARM scenarios to make the payment work. Buyers are not gone. They are selective, payment sensitive, and looking for someone who can create clarity. The bottom line is that oil is lower, bonds are rallying, and MBS are participating. That is constructive, but not yet a confirmed change in the longer-term rate trend. Use today's improvement to create conversations and opportunities. Do not use it to promise borrowers that rates are headed straight down. Execution still beats prediction. And if you are a loan officer who is open to learning how Central Coast Lending supports our loan officers with stronger tools, professional guidance, and the systems needed to grow their businesses, give me a call. I'd love to show you what we are building.